Hey everyone, welcome back to Corporate Decoder, the place where we break down the complex world of business and finance so you don't have to. And today we are diving deep into Black Hills Corporation's latest 10Q filing to see what the numbers are really telling us about their business direction and future prospects. Alright, so this is a quarterly report that companies file with the US Securities and Exchange Commission, or SEC, to give investors an update on their financial health. It covers the period up to the 30th of September of this year, 2025. Black Hills Corporation is an energy company providing electricity and natural gas to a lot of people across 8 states in the US. They have a long history going back to 1883. So they are not exactly a new player in the energy game. They operate under the name Black Hills Energy. Let's jump right into the numbers to see how they are doing this. Is the income statement, and it shows us their revenues and expenses for the 3 and 9 month periods ending the 30th of September in both 2025 and 2024. First up, revenue, or the money they brought in. Total revenue for the 3 months ending the 30th of September 2025 was $430.2 million, which is up from $401.6 million in the same period last year, 2024. That is a pretty nice jump of nearly 7%. For the 9-month period, revenue was $1.674.5 billion in 2025 compared to $1.530.6 billion in 2024, another solid increase of about 9%. This tells us they are selling more energy, which is generally a good sign. Now for the big expenses, fuel purchase, power, and the cost of natural gas sold, this also went up from $94.5 million in the 3-month period in 2024 to $112.0 million in 2025. That is an increase of almost 20% for just this one expense item. For the 9-month period, it went from $518.2 million to $595.7 million, an increase of about 15%. This shows that the cost of the energy they buy and sell is a major factor affecting their bottom line, and it is going up significantly. After all those expenses, they had an operating income of $78.7 million for the 3-month period, up from $75.8 million in 2024. For the 9-month period, operating income was $366.1 million, up from $339.8 million in 2024. So despite those rising fuel costs, they are still managing to grow their operating income, which is a positive sign. But then we hit interest expense. This is the cost of borrowing money. And wow, it is a big number for the 3-month period. It was $50.6 million. And for the 9-month period, it was $152.2 million. This is a huge chunk of their expenses, and it went up from last year, which means they either borrowed more money or are paying more interest on their existing debt. Looking at the very bottom line, net income available for common stock was $24.9 million for the 3-month period compared to $24.4 million in 2024. For the 9-month period, it was $186.6 million compared to $175.0 million in 2024. So the company is making more money overall. And for shareholders, that translates to earnings per S-share of $0.34 on a diluted basis for the most recent 3-month period, up slightly from $0.35 last year. For the 9-month period, it is $2.58 compared to $2.52. These numbers show a slight improvement for shareholders. Now let's look at the balance sheet. This is like a snapshot of the company's assets, liabilities, and equity at a specific point in time. Let's focus on the 30th of September 2025 and compare it to the 31st of December 2024. Accounts receivable, the money customers owe them, was $251.4 million at the end of September 2025, down from $351.2 million at the end of 2024. This decrease could mean they are collecting money from customers more efficiently, or perhaps that sales have slowed a bit compared to the end of last year. Their property, plant, and equipment, which is basically all the infrastructure they own like power lines and gas pipes, is a massive $10.1 billion. These investments are key for utility companies to keep their services running and for future growth. And then there is the debt. Long-term debt is $4.252.8 billion. It's a really big number, but it is only slightly up from $4.250.2 billion. At the end of 2024, the company is using a lot of borrowed money to fund its operations and investments, which is common in this industry, but it is definitely something to watch. Looking at the equity side, additional paid-in capital is $2.415.0 billion. This often represents the amount investors have paid for stock above its par value. This significantly increased from $2.193.4 billion at the end of 2024. This surge likely reflects the company selling more stock, which brings in cash, but also dilutes existing shareholders' ownership. Retained earnings, which is the profit the company has kept over time, is $1.289.0 billion, up from $1.249.1 billion. This indicates the company is profitable and reinvesting some of those profits back into the business. Now for some really big news that is looming over everything. They are in the process of merging with Northwestern Energy. On the 18th of August 2025, they announced a big deal to merge. This is a significant event that will change the company's structure and operations dramatically. They expect the deal to close in the second half of 2026. This merger is a major strategic move, and it is going to carry a lot of risks and opportunities, so we will keep a close eye on it. Let's talk about how they are getting their money from customers through regulatory bodies on the 14th of June 2024. Colorado Electric filed a rate review with the Colorado Public Utilities Commission, or CPU, to recover investments in their electric systems. On the 17th of March 2025, they got an order for a rate increase that should bring in about $17 million more in annual revenue. Then on May 6, 2025, they got an updated decision that boosted annual revenue by another $500,000. These rate increases are crucial for utility companies to cover their costs and invest in new infrastructure. Iowa Gas also had a rate review, and on the 1st of January 2025, they got approval for a settlement that should bring in $15 million in new annual revenue. This kind of regulatory action is standard for utilities and directly impacts their profitability. Kansas Gas also settled a rate review on the 24th of July 2025, and this is expected to bring in about $10.8 million in new annual revenue, and also shifts $4.4 million of revenue from a rider to base rates. This shows they are actively managing their revenue streams through regulatory channels. And in Nebraska, Nebraska Gas also reached a settlement that is expected to generate $23.9 million in new annual revenue. This settlement is subject to approval, but it shows important progress in securing their future income. Now let's talk about how they manage risk, especially with all the volatility in the energy markets. They use derivatives like futures and options to protect themselves from sudden price swings in natural gas and electricity. This is a complex area, but it is essential for them to manage the unpredictable nature of energy prices. For example, they had $8.0 million in derivative liabilities on the books at the end of September 2025. When talking about derivatives and other financial instruments, they have to report their fair value. This is essentially what they are worth on the open market level. One is based on quoted prices in active markets. Level 2 uses observable inputs, and level 3 relies more on estimates. For their commodity derivatives in gas utilities, they reported $5.2 million in assets and $5.2 million in liabilities at the end of September 2025. Like most large companies, they have employee benefit plans. Their net periodic expense for these plans was $0.7 million for the 3-month period in 2025 for their defined benefit pension plan, showing the ongoing cost of supporting their employees' retirement. Income taxes are always a big factor, and they had $4.0 million in expenses for the 3-month period in 2025 compared to $2.9 million in 2024. Their effective tax rate was 13.5% in 2025, up from 10% in 2024. The report mentions this increase is partly due to non-deductible merger-related costs, which is important to note. Breaking down the company's performance by segment is key. They have two main segments, electric utilities and gas utilities. Their electric utilities segment brought in $249.7 million in revenue for the 3 months ending the 30th of September 2025, while gas utilities brought in $184.4 million. The gas utility segment saw a much larger increase in operating income of $9.9 million compared to the electric utility segment, which saw a decrease of $2.7 million. This indicates the gas side is performing stronger right now. Looking ahead at their investments, capital expenditures were a whopping $608.5 million for the first 9 months of 2025, and they forecast over $1 billion for all of 2025. The vast majority of this is going into their electric utility segment, which shows their commitment to modernizing and expanding this side of their business. Their credit rating from S&P is BBB with a stable outlook, and from Moody's it is Baa2, also stable. These ratings are important because they affect how much it costs for them to borrow money. Generally, good ratings mean lower borrowing costs, which is a plus for the company. Now let's talk about risks, and there are some significant ones, especially with this pending merger with Northwestern. The report highlights that the merger could be delayed or even fail if they don't get the necessary approvals from shareholders and regulators. If the merger doesn't happen, it could hurt their stock price and future business plans. There are also risks if the merger goes through, but conditions are imposed by regulators that might not be good for the combined company. They also mention the possibility of losing key employees due to uncertainty around the merger, which could impact operations. They also reported acquiring 129 shares of their own stock during July, August, and September of 2025. These shares were bought back to cover taxes related to employee stock plans, not open market share buybacks. For companies involved in energy production, especially those dealing with coal safety, is a big deal. Black Hills has mine operations. So they do have to file mine safety disclosures. So what is the big picture here? Black Hills Corporation is showing growth in revenue and operating income, thanks to rate increases and strong demand, especially in their gas utilities segment. However, they are carrying a lot of debt, and the massive investment in capital projects signal a future focus on infrastructure and expansion. The looming merger with Northwestern Energy is the elephant in the room. It is a huge undertaking with significant potential benefits, but also considerable risks and uncertainties. If it doesn't go as planned, the company is navigating a complex regulatory environment, and rising energy costs will continue to be a pressure point. Their ability to successfully integrate Northwestern and manage their debt levels will be critical to their long-term success. What do you think about Black Hills Corporation's strategy and their upcoming merger? Let us know your thoughts in the comments below. If you found this breakdown valuable, please hit that like button and subscribe to Corporate Decoder for more in-depth analysis of company filings. And don't forget to join our Discord community linked in the description for even more insights and discuss. Ions. Thanks for watching. See you next time.